Hello everyone, welcome back to Financial News. I'm Ron Jankowski with Channel 4 and Palos Heights. And of course we always have Paul Munichel with us from Ameriprise Financial. And Paul, I'm going to let you start. I'm sure we have a few things to discuss.
Yeah, thanks Ron. So our first show for the year 2020. So I'll begin by just recapping in general last year's market performance. Last year, 2019, the market delivered strong performance, regaining ground we lost back in 2018. Looking at the stock side to begin with, the S&P 500 index posted a strong return last year of 31.5% to the positive side. That was its best year since the year 2013, so a long time coming and deserved. Foreign market equities also did very well, just underperformed our market, and emerging market stocks trailed all the other major markets, but still strong positive returns for our domestic market last year. On the fixed income side, bonds also had a really good year, just they were overshadowed by the strong equity market. Using the Bloomberg Barclays US aggregate as a judge, it posted a positive 8.7% return, its best annual return going back to the year 2002. Core bonds outperformed by non-core sectors as emerging market and high yield both benefited from the rally in the risk assets. Moving on to alternative strategies, we used the Wilshire Liquid Alternatives Index as a judge, posted a positive 6.7% return, again overshadowed by both stocks and bonds, but when you measure in the volatility index, which was very low, it did provide a very positive or favorable risk to return trade-off. While 2019 was an impressive year for performance across all asset classes, it's important to keep in mind the market environment that preceded it. So we got to remember that 2018 was a rough year, especially in the month of December. So when you averaged out 2018's return with 2019 return, it did put us kind of on mark for an average long-term growth. 2020, which we are gratefully in now, we're expecting modest growth, similar to what we saw in 2019. We are anticipating positive returns in the markets again, but low ratings, nothing like 2019. The wild cards, of course, are really the same things we keep talking about on the show, trade and politics. We know we got a presidential election, which is going to be very heated this year, and the trade talks, which we've talked about many times on the show with China, are still going to be a big deal. When building your portfolio, it's best to think about being diversified across asset classes and truly understanding your risk tolerance, because it could be a volatile year this year.
All right, very good. And I'm going to give the morning notes that we received from Ameriprise Financial, effective today, January 13, 2020. S&P 500 index futures are pointing to a higher open as the domestic benchmark close looks to recoup Friday's 0.3% decline. Any comments, Paul?
We've had some volatility early in the year already. I know it's only what is it today, January 13th, but we've had, of course, the attacks on Iran, the retaliations. So that's been a lot that's started out our year. So we've seen volatility, and as you just reported, we were down on Friday, but the market is resilient, and it seems to bounce back lately after any down day.
And when it bounces back, it breaks a record.
When you're at close to all-time highs, it just takes 1 point higher to reach a new all-time high.
And you're there.
Yep.
And stocks in Asia closed mostly higher overnight as investors await the signing of a Phase 1 trade deal between U.S. and China. And of course, you've already addressed that issue. The yield on the 10-year Treasury is higher to near 1.83%, and while the 30-year is holding just below 2.30%.
I'm going to talk about that in the second half of the show, our expectations for fixed income in 2020.
Very good, very good. After a volatile start to the year, WTI crude oil is holding steady near $59 a barrel as traders shift their focus away from Mid-East tensions to the U.S.-China trade deal. And of course, if that oil continues to hold well, then our gas prices are pretty much going to hold as they are today.
Yep, threats of war, of course, make oil come up, and as those subside, the cost of oil seems to be falling. Everything seems to be in line with how it should react to what's going on.
And these are year-to-date, and of course they're all low because we're at the very beginning of the year. The S&P 500 year-to-date is a plus 1.13%. The Dow Jones is a plus 1%. The NASDAQ Composite is a 2.32% all year-to-date. Now, I did receive a comment from a viewer. And Paul, if you're not ready to answer this question, they would like to have some information as could we advise them what is going on with Amazon and what is going on with Apple? And if you're not prepared for that, let's answer the viewer next our next show.
Absolutely. We have research reports on a lot of different equities, those two being some pretty big ones. I can bring some information on them, and we can talk about them on another show.
Very good. Well, it pretty much covers it. Stay with us. We're going to be right back with another show called Your Money. Paul usually has some very interesting topics. Stay with us. We'll be right back. All right, thanks for staying with us. We're back with the Your Money show. Paul usually has a comment or two about something very particular, and today he's going to be talking about what to expect for 2020. Paul, I'm going to let you take the show from there.
Thanks, Ron. Really, to start out 2020, it's the same debate we had at the end of 2019. It's all about the bull market, and the debate is the bull going to keep running, or are we going to see the bear market come into play? So I've got some of our committee perspectives here. I'm going to just gloss over them. To any viewer at home that would want more specifics on all this, I mean, the report is 13 pages long here. I'm just going to go through a few topics today. So if you're looking for more detailed information, I'm happy to get this report out to anyone. Feel free to contact me at my office, and I'll get that to you. And again, my number is 708-226-3412. But let's begin. So some key points to consider for the year 2020, really no different than 2019. We still have unresolved trade issues. Ron alluded to that with the China signing of the trade deal, stage 1 potentially. Now we're already got the heightened U.S. political anxiety and elevated geopolitical tensions with the presidential election and tensions with overseas. There's a lot going on, which the market does not like uncertainty. All things we need to consider. But with that all being said, the U.S. economy is strong, and we're confident that consumer is going to keep building into this market, mainly because employment numbers are still strong. Potentially, we can see the unemployment rate drop to as low as 3.3% this year. If it does that, that's the lowest unemployment since the 1950s. With all those people working and with all them making a little bit more money, that could keep the economy moving forward and thus keeping the stock market positive for 2020. So Ameriprise's 2020 base scenario for the market calls for modest economic growth accompanied by low but definitely positive market gains. Wild cards again are trade and politics, we know that. One of your best defenses against a volatile year like we're predicting is to stay diversified and to know your risk tolerance. This could be a roller coaster ride of a year. It could end up being positive for your portfolio, but roller coaster year statement could be up 1 month, down the next, up the next, down for the next 2. It could be a wild ride, but if you play it properly, it could be a positive year for you.
And the only way to protect yourself is get a financial advisor to guide you through that process.
Yep, and kind of know what you're getting into. I mean, we're doing our best to try and warn people that with all these issues that are out there, doesn't mean it has to be a negative year. It just expect a lot of volatility. 2020 S&P 500 year-end target from Ameriprise, this is our base scenario, is 3,350, which implies roughly a 6% return on the year. And of course, we will adjust this usually mid-year, but that's our prediction now. Ameriprise expects modest earnings growth, stable cash flows, and profit margins to little expansion. investors may require companies to deliver on expectations before pushing stock prices materially higher from current levels. GDP estimates, we're going to predict that at about 2.1% growth for GDP. The U.S. consumer, as we said, is working. The consumer is confident and they're willing to spend right now. That all helps the economy. And to support growth in 2020, these conditions need to remain in place. And if they do, a solid consumer should more than offset any further weakness in business investment. And looking at the fixed income market, our prediction for 2020 on the Treasury yield curve, this is the 10-year Treasury, is 2%. The Federal Reserve may hold its policy and its interest rates static in 2020, and inflation seems to be tame, which gives us our outlook for about a 2% 10-year Treasury on the fixed income side. The only other information I had for you guys today from this report, and again, I can't say it enough, I'm happy to get out the full report to anyone that wants it. Some big picture themes to look at. Trade issues are a big deal, can't stress it enough. Heightened geopolitical issues are a big one, and again, the potential of volatility arriving from the presidential election. Portfolio positioning. On the equity side, you may want to consider focusing more on quality stocks that are paying dividend incomes and the potential to grow that dividend income. Interest rates were cut last year, leaving the interest rate very low. So you potentially will see low CD rates, low money market rates. If you're looking for yield and growth, you may want to consider strong dividend performers on that side. And we think that keeps that sector of the stock market doing well. On the fixed income side, potentially avoid reaching for high yield. By doing that, you lower your quality of your bond. We recommend, maybe because of the volatility, considering a higher quality bond and foregoing a little bit of yield on the bond side. And can't say it enough, to anyone that knows Ron and I, we always recommend focusing on a diversified portfolio amongst all asset classes. Last year, you probably could have gotten away with not being so diversified because the market performed so well. This year, with what we're expecting, we really think you need to be diversified. So we do recommend talking to your financial advisor that you're working with or doing your own research. Your portfolio should look a little bit different than it did last year if you went aggressive last year into the stock market.
You want to be in a position where you could take the ride up and down and through the market, whatever it does, and not affect you.
Right.
At least not affect your portfolio is what I mean.
Exactly. I mean, we certainly have no crystal ball, not claiming to have one.
Exactly.
But all the data is there to support a pretty volatile year. So let's be prepared for it and be ready.
Okay. Now, if a viewer would like to ask you a question, Paul?
Yes, they can feel free to call me directly at my Ameriprise office locally here at 708-226-3412.
All right. Thank you again for bringing all this information to the viewers. For Paul Munichel with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you good investment day.